Hey there, everyone. Hello out there. We are live. Looks like there was an error, so I really don't know if I'm live or not. I think I'm live on Facebook, but let's see if I'm live anywhere else. Heads up, Facebook requires you to go live. Let's try again. All right, we're having a little technical difficulty here, but we have it straightened out. And we are live. Yes, I can hear you. So we're live. Let me fix the screen. Okay, good to be back in the studio. I'm going to start over. And we're live. This is Mitch Goldberg, and you are watching a new episode of Be the Boss of Your Money. Why? Because I want you to be the boss of your money and not your money to be the boss of you. We've got a couple of things to cover here, like today's bounce in the stock market. I mean, is that it? Is the bear market over? Did we just find the bottom of this trading range that we're in, that we hit highs about, or at least we got flat for the year? We hit the highest level since the pandemic started about 4 weeks ago. We've been coming off that ever since. Stocks are down about 10, 11, 12%. Now they're maybe off about 10%, 9%. I think it's too early to act. I think it's a little too early to actually tell if, in fact, we have finished bottoming out. But I don't know if it really matters, okay? Because if you're a long-term investor, which is really the most important thing, and you've got quality diversification. The reason why we have diversification is because you don't always realize whether or not you have quality until time passes as developments go by. So that's what we're going to talk about today. I also want to talk to you about do-it-yourself investing. Now, with the rise of fractional ownership, like you can put $50, for example, into Amazon instead of $2,500 for one share, and free trading, commission-free trading. And, we all talk about, what's on the tip of everybody's tongue is the Robinhood app. So let's talk about all of this and what it takes, the 7 essential traits of what it takes to be a good do-it-yourself investor. So we're going to roll the introduction. I'm going to take your comments, your questions rather, and we're going to get through this. So let's get the intro going. Okay, thank you for joining me. My name is Mitch Goldberg. If we haven't met yet, I'm a financial advisor with about a little over 30 years of experience now. I am with the wealth management firm Client First Strategy. And what I want to talk to you about today is our quick review, the update for today, because you have to ask yourself, after the dismal week we had last week, we closed the week last Friday down over 700 points in the Dow. And things were really gloomy with the number of COVID cases spiking in over half the states in the country, and spiking a lot. And a higher percentage of people who are testing positive are going to the hospital. But also a lot of them are younger. However, the disease continues to spread, and it seems to be accelerating, especially in states that have gone to full reopening. Even in states that have said they, that had a phased in opening, it's starting to spread. I'm in New York, and the governor here is talking about cases still going down here. I'm actually worried that people get lazy, complacent, and cases start to spike here because it's such a contagious disease. Listen, I'm not here to be an epidemiologist. What I am here to do is talk to you about possibilities of what can happen, of what we have to look out for, because we need to know, are we in a recession, in a bear market that goes on till 2022, 2023? Or do we crawl out of this over the next 6 months? I mean, I've been in long recessions and long bear markets in the past, and they are painful. And what we've seen so far, believe it or not, as swift as the downside was, most of it's recovered. It hasn't been too bad. The major averages are really not down that much year to date. And if you didn't see what happened, 2 months ago in the major averages, and you just looked at where we were last December 31st, where we are now, you would say, it's barely a correction. As a matter of fact, the NASDAQ is right off its all-time high. Last week, up to like Wednesday or Thursday last week, the NASDAQ composite was hitting new all-time record highs. So things aren't too bad, but what comes next is always what we want to know, and we have to take a look. I wouldn't blame you if you expected this to be a down day, because all you read about during the weekend were the headlines of how Florida, Saturday and Sunday, reporting over 9,000 new cases, record cases. Today it's a lot less, like 5,500 or so new cases. But Texas has slammed shut their their reopening phases. Florida, statewide, no serving alcohol in any bars. Why? Because they're targeting the young people who are being accused, and I think rightfully so in a lot of places. Okay, let's give credit where it's due. Listen, a lot of people are not respecting and following social distancing, mask wearing guidelines. At least Health Secretary Azar is starting to say wear a mask, and I still see people out there who are debating. We're not even debating like, oh, wearing a mask is ridiculous. Oh, it's some of the things I'm reading on social media. It's just very unfortunate for some people. I pray for those people. And if any of you who are my friends who get sick, who are anti-mask, you know something? If you have to stay home, you quarantine, you're not doing well, you can still call me because we're still friends. And I will bring you supplies. I will bring you food, gloves, masks, whatever you need to help you get through it, because we're still friends. All right? I don't want to judge my friends based on politics. Okay, so we had a big rise in pending home sales. So thank the millennials. They are going out, buying houses in droves. A lot of people decided, I don't want to live in the city anymore. I used to want the downtowns, the walk to work, the walk to the train station. They're getting out of Dodge. They want to go to the suburbs. They want some space. They want a backyard. They want to be able to sit at the backyard, on their backyard patio, sit at their nice table with the umbrella, crank up the barbecue, make some burgers, and have a life. Tired of the city, and work from home. I'm wondering how the real estate market's going to play, the commercial real estate. I would be negative on the commercial office space market, but if you think about the suburbs, all those people who commute to the suburbs, from the suburbs rather to the city every day. I'm thinking in Long Island, New York City. You have a lot of those people who might still be willing to work in an office, just maybe they don't want that Long Island Railroad and subway commute. Maybe that's happening all over the country. Okay, so anyone who watches this show knows we like to do a quick review, not just a review, but a review with perspective. Welcome to the show, folks. If you have any questions, please ask me in the comments. I'd love to answer them. Words of encouragement are always appreciated. So let's take a look. Did the Dow actually and the rest of the market hit its low of this nasty 3-week cycle we're in? I think that's a bit optimistic. What today's rally was all about was the impact, how much of an impact that just a few large cap stocks could actually have. So today was all about Boeing and Apple having big up days. So, really big stocks, individual corporate news can still move the market. I actually think that is a good thing, that we're going by individual stock names as opposed to just buying the S&P ETF, selling the S&P ETF, and that's the whole investment strategy. Okay, so let's take a look. We'll do a quick share screen. I work my controls. I have the wireless mouse over here, and it comes together. So we'll just do a quick review because it's a nice day out, and I think a lot of people, we'll see if you watch this. If you're watching this in the replay, ask any questions you may have as if you're watching this in the live stream, and I'll be looking out for those. I love when people ask me questions. So you see here the Dow up almost 600 points, S&P up 1.4%, NASDAQ up 1.2%. Do you know why the Dow is up over 2.3%? the S&P was up only 1.47%, and the Nasdaq was only up 1.2%. Because the major contributor to the day was one stock, Boeing. Because the corporate news is that Boeing will, now start working on resuming flights of their MAX 700 model. That is a major piece of corporate news, and I really hope they have it straightened out. The entire evolution of air travel in the whole globe was predicated on going from the old Boeing 7 series to the new MAX 7, MAX 800, MAX 900 jets, 700, 800, 900 series. So, and that was going to provide Boeing with a steady stream of like annuitized income for the next 20 years, like trillions of dollars. So my sense is that people will look back, in a few years at this time and say, oh, what a bargain that was. But it's going to take a while. And well, today, Southwest Airlines actually caught an upgrade. This is the first time I've seen an airline stock catch an upgrade in a long time. But Goldman Sachs went from a sell rating to a buy rating on Southwest Airlines. They didn't go from sell to neutral to buy. They just went straight up to buy. That's a pretty positive thing, and that's because Southwest does not really do a lot of business travel. I'm not saying business travelers don't use Southwest, but it's mostly retail customer and domestic, and Goldman Sachs expects that space in the airline travel industry to pick up first. The VIX was down about 8.5%. That's pretty good. The VIX has been very sticky over 30. And when the VIX gets down below 30, that is an indicator that professional investors are starting to relax a little bit more and maybe willing to commit some more dollars to the market. Okay, so let's take a look. While you see that up at the top, Bank of America, Citi, and Goldman will keep their dividends the same post-stress test. Looks like Wells Fargo said they're going to cut the dividends. So let me just give you a quick quote. I've got so many screens going, it's just easier if I just jump right on my CNBC app, which I think is a terrific app, by the way. But Wells Fargo is down 44 cents, not a major hit in aftermarket trading. I think a lot of people expected of the major banks that Wells Fargo is the one, the problem child that's going to cut the dividend. Just seems that company just, they've got a really bad history of doing a lot of bad things, and they're still paying for it. And, when is that over? It's tough to say. When is the stock a good buy? We have to compare that to the other bank stocks like Citi and JP Morgan and Bank of America. And those other stocks have similar valuations. You just don't have as much hair on it. They're just cleaner stories. So why do we want to get involved with whether or not politicians want to attack Wells Fargo for their misdeeds, like opening up millions and millions of accounts in people's names without even telling people? It's okay. So let's go on. We will take a look at the next screen. Market movers. Forget the losers. The movers today. Boeing. Look at Boeing up 15%, almost back up to $200 a share. Cody was up. They just invested a lot of money in. I think they took over Kim Kardashian's, or they bought 20% of Kim Kardashian's makeup line. They already have, I think, 51% of Khloe Kardashian's makeup line. So they're really betting big on the Kardashian name. Kohl's recovered a little, up 10%. Simon Property Group, Simon Malls. There's a few Simon Malls near me. They're very nice malls. That's up. Southwest up almost 10%. Okay, cruise lines are up. SL Green Realty, they have a lot of office space in Manhattan. Alaska Air was up. Okay, let's take a look at the next one. It's easier for me to look at my screen over here, so that's why you see my head go that way, okay? But look at this, Facebook recovering. There's a big boycott of companies, major companies like Starbucks and Verizon are saying, we're not going to advertise in social media until you clean up the hate. I'm so happy that corporations are taking that stance. Okay, you have to be careful of what you post, and the idea with Facebook and Twitter is, look, we're just the mechanism that people use to post. But got to enforce the rules, and they have to really do better. Apple up $8 today. That helped the S&P. It helped the Nasdaq. It helped everything. Amazon off a touch, but Netflix up, Google up, Microsoft up. So the FANG plus M stocks were up today for the most part. The Chrono Zoom is off 8. Listen, the stock just rounded 200. It's been a huge winner this year, so that's okay. Clorox continuing to trade above 200. Peloton off a touch, Activision off a touch, but they've been big winners. We have Domino's up a little, Campbell Soup. So, an okay day for the stay-at-home, work-from-home, and pantry stocks. Let's go on. And here's what I always look at, the sector ETFs. Industrials were the winner. That's really important. That kind of gets you back to not quite the V-shaped recovery. I always talk about, is it a V-shape, a U-shape, a W-shape kind of day, an L-shape. Last week was like L-shape. Industrials and materials are up. That's really good. But also consumer staples and utilities were at the top, running at the top. And financials were a little, toward the bottom. I'll see if we can get a quote on the XLF. That's why the screen is white. It just takes a second. I bet you I could get it quicker on my cell phone. Oh, there it is. Okay, so the XLF is up a touch after market. Most companies are going to maintain their dividends. Last week we had the results of the Fed stress test on the banking sector, because it's really important now because of the pandemic and the recession that we're in. And lastly, let's take a look at, I was going to show you the transportation, the ETF that covers the transportations. Transportations had a really, really good day. And the iShares has an ETF that follows the transportation index, the Dow Jones Transportation Index. You can't invest directly into an index, by the way. You could invest in a security that tracks or mimics an index. So just have to clear that up with everybody and let you know that the Dow Jones Transportation Index doesn't even have any commercial airline companies in it. That's like UPS, FedEx, some railroads, and that had a pretty good day. So when you start seeing that go up, I think that's a sign that, the shutdowns, we haven't seen that they're hurting the economy. You see, the whole point with the slowing down of the opening is that it's going to slow down the reopening story of the U.S. economy. We wouldn't see that. It just really came to the fore last week, where people started to get really nervous about it. We wouldn't see it show up in the numbers so quickly. And the last thing is this. I'll stop the screen share. The last big thing is this. On Thursday, because the markets close on Friday for the July 4th holiday, which is Saturday. So Thursday, the Department of Labor announces their monthly non-farm payroll numbers. So that's when we see how many jobs were either lost or created in the economy for the month of June. And we also will find out what the unemployment rate is. A lot of the states were opening up through most of June. So I still think we could get a pretty decent employment number. Now we have to worry, to the last week or so of the rapid spread of COVID, does that slow things down heading into July and August? That's what we have to see. And it's so uncertain right now. It's really, if you're making short-term directional bets, good luck. It's really tough to see what it is. And I know somebody's going to make a bet in the right direction, and they'll say, you see, I knew. But to me right now, it's a coin toss. Let's talk about personal investing and whether or not you have the 7 traits necessary to be a do-it-yourself investor. Listen, there are so many modes of investing today. There are more tools today than ever for the do-it-yourself investor. And hey, I'm not here to knock anyone, and I don't think anyone should come out and say, oh, you should only invest with a financial advisor. It's so self-serving when people in the financial services industry say that. People are allowed to do things themselves. And listen, I would rather people try to figure out how to invest properly for themselves before they even become my client. That's me personally, because I feel that person who does come to me will have a lot more respect for how difficult my job could be. And that's important. Look, if you're a professional, you want your client to understand that your job is not easy. Now, I'm not saying it's always complex and it's always the most difficult thing, but there are ups and downs like any other career in financial services. Then there's, there are tough times, there are easy times, but when the tough times happen, that's what we get paid for. And I'm not here to say that financial advisors should make things more complicated. To me, a good financial advisor understands how complex and sophisticated markets and personal finance could be, but a good one will simplify it for their client. That to me is very important. Now, the do-it-yourself traits for an investor go like this. I wrote an article about this about 5 years ago for CNBC, and I'm really proud of the article. And I was thinking, what would I talk about today? Because I don't want to just talk about how the market did today. You can get an update anywhere. I do add perspective to my updates, so my updates are better. They're a little bit different. So some of the traits that you have to look for is time, for example. That's the first one. Do you have time to be a do-it-yourself investor? Are you the type of person who you want to set it and forget it, and that's the extent of time that you're going to put into your investing? You're welcome to do that, but things change. So, do you have the time to reassess your financial means, your financial goals? Do you have time to reassess whether or not the investments you chose are still appropriate for your risk tolerance, time horizon, and financial goals? You have the time to determine whether or not you should make any changes or rebalance your account. Okay, the next one is discipline. And look, I think you could say discipline is the most important trait for every career. Okay, but discipline does take discipline, and you need to know if you have it. Now, are you one of the people who in, like, let's say 08, 09, who didn't open up your brokerage statements, your 401k statement, because you didn't want to know how bad things were? Listen, that might be the best strategy for a lot of people. If you're just investing every month into your 401k and you have an asset allocation that's appropriate for you, you don't have to worry about it. Just keep investing. Are you the type of person who decides you want to sell all of your investments because we're in a pandemic and the market went down a lot, and you feel that you're going to just buy everything back when times are better, when things clear up? Because if you're doing that, you're basically saying you want to buy when everything goes back up. Because by the time things are better and clear up with this pandemic, stocks will move up well ahead of that. What happens is you become an endless procrastinator when you don't have discipline, because then you're waiting for a better market to buy, a lower market to buy. The market goes up and you say, I could have bought when things were lower. I'm going to wait till things go lower. And when stocks go lower in price, then you'll say, it looks pretty bad. I'm going to wait till they go lower. And then they recover. And you say, but I could have had them lower. And it's just endless procrastination. Remember, folks, it's not timing the market. It's time in the market. Remember that. It's not timing the market. It's time in the market. That's how you build wealth. The idea is not to sell everything in your 401k plan or whatever accounts you're using, your individual account, what have you, when stocks go down, or ETFs and mutual funds when they all go down. The idea is to hold on to them and keep reinvesting, and you're reinvesting dividends and capital gains into more shares at lower prices. And you're buying more shares because the market's down. Prices are down, same amount of money, so you're getting more shares. And this has an effect. It's a compounding effect over time. And like Albert Einstein once said, the most powerful force in the universe is compounding. So if you sell everything in a down market and you try to time a down market, what you're really doing is you're giving up your compounding. And over time, it's the compounding that makes your accounts go up over time, not you trying to time it to buy and sell. Okay, so that's what I talk about for discipline. Confidence. Well, it takes a lot of confidence to be an investor, let alone a do-it-yourself investor. You really have to have confidence that you've done the correct homework, that you've made the right decision. No, I'm telling you this, no one can have all of the information possibly in the world every time you make an investment decision. But do you have the confidence in your own ability to say, I've done everything I could. Confidence is a really important part of investing, because if you don't have confidence, you'll never get started. And if you don't get started, you'll never learn. I'll tell you something. And I've been talking a lot about the Robinhood app and do-it-yourself investors. And I think that's why this is so timely to talk about. I think that's why it's so timely to talk about this, about do-it-yourself investing, because of the rise of Robinhood. All right, people are learning. Robinhood is known for the millennials' choice of investing and trading and learning, and there's a lot of reasons for it. It's fun. You don't need a lot of money to do it. The investment financial advisor community has turned their back on that cohort, because look, how many financial advisors are going to say to a client, "Oh, you have $2,000 to invest? Yeah, sure, be my client." The financial advisory industry does not make money from those clients, and the client won't get serviced properly. It's the way it is. I'm not saying I'm happy about it. So I want to teach you how to be a better investor. And some of you watching this will stay do-it-yourself investors. Some of you will just say, you know what, now I realize the benefit of having a financial advisor for me. Just because it's not going to be a benefit for everybody, but maybe for you it is. And hopefully you'll come to me. We're another financial advisor who you know and love, okay, and trust and respect and all that good stuff. Or you'll do both. Take a hybrid approach, and with a do-it-yourself option and a professionally managed option. There's nothing wrong with that. All right? In fact, I think that is really the wave of the future. All right. So, are you a procrastinator? Do you tend to overreact in stressful situations? Because investing has a lot to do with emotions and herd mentality. All right. Did you buy a stock that you said, when you thought it's when it goes down, I'm going to buy more of a stock that you have your eye on? Did you actually do it? Did you have a strategy in place? Did you have a buy limit order in to buy that stock? You have to have confidence to do these things. The next one is experience. Now, experience is a touchy one. Can we just take a sip of water here? There's a lot of lights on me right now. So now, experience is a funny thing, because I'm not saying to you that you need experience to get started, because everyone has to start out as a novice. But do you know people who have experience? Do you know people who are truly honest about their experiences and the lessons that they've learned from their mistakes? So if you don't have your own experience, at least you can use somebody else's experience. I can tell you that financial advisors, there are a lot of us who have a lot of experience. Plus, we have the experience of hopefully being interested in markets and investing in personal finance. We put we put all of that information and that knowledge and perspective to use for clients. So when a client, for example, comes to me and says, "Hey, I'm thinking about doing this or that," I can speak to them intelligently and help them break down the process to make the right decision for that person, kind of like a coach. I do consider myself a financial coach, like 100% of the time. But that's where experience comes from. If you have to start somewhere. The nice thing is you can start small. And that's the good thing about, dare I'll be the only person to ever say this, but that's the good thing about the last few bubbles we've seen. We had the bubble in Bitcoin, crypto, then the pot stocks, and it looks like we had a bubble in stocks that are worthless, like Hertz and Chesapeake Energy, for example. People are trading these stocks that have no intrinsic value. I don't think people are trading these stocks are looking at them and analyzing the company. They just see it as a tradable vehicle. And if you're trading, that's totally fine. When we're trading, we're not concerned about what the company does. It's all about the price. You buy low, you sell high. That's all we want to do. Mission accomplished. As opposed to an investor who says, I want to buy the stock because I believe that corporate actions over the next 2 years, 5 years, 10 years plus will turn this company into a bigger and bigger entity. And that's how I'll make money. Traders could make a living. They could make money. Some can make a lot of money. Most don't. But investors over time can make a seriously lot of money. Look, you didn't see Bill Gates trading Microsoft. He owned Microsoft. You didn't see Mark Zuckerberg trading Facebook. Not to say that these people never liquidate some shares, because they can't eat stock. They have to liquidate some shares to get some cash, to buy a house, to buy their lifestyle and pay for things. But by and large, they're not buying and selling. they're owners. And I think over time, the most successful investors I've seen are owners. Okay, so you have to get experience somehow. And I'll just give you a quick little story. Someone very close to me, actually my nephew, bought some Bitcoin, and he made money with it. He put a little bit in. It went up a crazy amount, came down a lot. Still made a couple of bucks. And his dad was like, I don't know, is that a good idea? It's gambling. I'm like, you know what? He'll learn more from that about the market and investing and trading and all that goes with it than he will in college. It's called experience, and better to learn with a couple of bucks than to start out with all of your hard-earned cash or when you've accumulated a lot of assets. See, a lot of people on Robinhood and other do-it-yourself investors who are young, you're starting out with a smaller asset base. You don't have a lot to work with. You could afford to make a mistake because you've got nothing but time to recover. But there comes a time when you hit your 30s, your 40s, you start rolling over your 401ks, you start saving some money, and before you know it, you're talking about a pretty large nest egg, and that's when your needs become more complex. Your risk of a mistake become a lot bigger. And that is more or less when somebody starts to think about hiring a financial advisor, okay? And another thing is staying current. Are you staying current? Now, I'm a news junkie. I love the news. I watch the news. I read the news. It's who I am. So are you paying attention to your assets? Are you paying attention to your stocks? Are you absorbing the news? And that's what I mean by staying current. Okay, there is a lot going on with politics. There's a lot going on with the Federal Reserve and policy. You may have heard about the CARES Act. You may have heard about the Federal Reserve buying corporate bonds. You may have heard about all of these very newsworthy events in economic and financial news. You should know about them. I'm not saying you have to be an expert in central bank monetary policy, but you should at least know about them because maybe they'll change your mind about what you're doing. I don't want you to go into things with your eyes closed, but part of your eyes closed are, you just don't know what you don't know until you go out and you discover all of this material. And that's why I say I actually like clients who have some experience on their own, and then they come to me because there's a greater appreciation for how tough it is. Plus, I feel like I can talk to somebody more professional. It doesn't mean I'm always putting in the the Wall Street jargon and the lingo when I talk to people. I do my best to actually get rid of the lingo because I want to keep it eye to eye or eye level. Okay. And the last thing is, do you sweat the details? Or do you thrive on the details? So as your portfolio goes up, it becomes you might become more risk averse because now you're playing with a lot more money. Look, if you're investing $10,000, you lose 20% of your money. You could live with it. What if you have $500,000 and you lose 40% of your money? Ooh, that's a lot of money to be down. Maybe you just don't want that. Are you aware of where your investments should be? Like, different types of accounts have different types of tax status. Now, I'm not a CPA. I don't give tax advice. You need to speak with your own tax advisor about this. But do you know about maybe converting some of your IRA money into a Roth IRA when the market's down? Did you take advantage of the down market 2 months ago to do that? Maybe you need to know that when you do a rollover with your 401k plan, you're best off doing a direct rollover because you don't want to get hit with a massive tax penalty and early distribution penalty if you do your rollover incorrectly. When you leave your job, you have a 401k plan, and you could roll it over into an IRA. You don't want to take the check, but you could take a check to roll over your IRA. You just take a personal check, open up an IRA at another institution, and then put that money into the IRA. You'll be okay. But what if you have 60 days to do it, but what if 61 days go by? What if you weren't aware that, by the way, if you decide you're going to keep the money, that all of that money you took becomes fully taxable, plus a 10% early distribution penalty. These are the kinds of things that you need to know to be a do-it-yourself investor. And then there are other things like, do you have a will? Do you have your beneficiary designations all set up correctly? Do you know which assets are best off in a retirement account versus a taxable account? These are the things you need to know in order to be a do-it-yourself investor. The information is out there. It's up to you to find it, to absorb it, to practice it, and live it. You'll make mistakes along the way. Listen, it's hard enough for financial advisors who've been doing this as long as I have to avoid all mistakes. Nobody could do it. But the idea is to acknowledge the mistake, accept it, fix it, and move on. Because I've learned from my experience, accepting a mistake is hard. But as you get older, you realize the faster you fix it, the better off you are. As opposed to when you're not as experienced, it's a tough thing to do to fix it. Let's see who's out there, and then we're going to get going, okay? Hey, Steve, we're good, man. We're all good. Great to see you. Do I? You know, I've been going on for so long, I'm not even sure which part of the live stream you're talking about. But this has been a long one, so I'm going to get going. You have any comments or questions? Any questions, I should say? Hit me up, and I'll speak to you soon. Thanks for watching. I'm Mitch. I'll see you tomorrow.